Hello, my friend. Welcome to Charlie Retail Invest. Let's track the latest trend in US economy and share our updated analysis of stock and bond markets. Today is Friday, October 18th, and it's just 3 weeks away from the US presidential election on November 5th. And voters across different states have already mailed in their ballots and have made their choices on either Trump or Harris. Right now, odds are in favor of Trump as the next US president, with a 58% probability to win compared to 42% odds of Harris, according to the bet market, as most American citizens are very unhappy about Biden and Harris administration's policies that led to high inflation, open US border, and surging illegal immigrants over the past 4 years. We can see that since the first rate cut by the Federal Reserve on September 18, Treasury bond, especially long bond like TLT, has been decreasing in price. From mid-September till now, TLT's price has dropped by over 7% in more than 3 weeks, with its peak value at $101.3 per share on September 16 and $93.7 per share on October 17th. Many bond investors have suffered from the continued decline of the bond prices over the past month. Behind the drop of bond prices, the reality is that the 10-year and 20-year interest rates have been kept rising since the Fed cutting benchmark interest rate in September. From this chart, we can see that 20-year Treasury yield has risen from around 4% in mid-September all the way to almost 4.5% in mid-October. We know that there is a strong correlation between bond yield and inflation rate, or CPI. If the CPI number is at a high level, bond yield, especially long bond yield, will keep at a high level. On the contrary, if CPI drops significantly, then bond yield will also decrease, which means that bond price will continue to increase. This is easy to understand, as CPI indicates how quickly the US dollar depreciates its value. And if we lend our money to the US government, we need to be paid back with interest rate that matches the depreciation rate of the dollar, hence the CPI number. Now, for 10-year Treasury bond, its yield is usually 1% higher than the current CPI, and 20-year Treasury bond has an even higher yield than 10-year bond, with its yield roughly 1.2% to 1.3% higher than the current CPI. This is because the longer duration of the bond, the more opportunity cost we, as the lender, will have to take, and we need to be rewarded with a higher yield. From the federal government's published data, we can see the core CPI of September 2024 is at 2.4%, which is slightly lower than 2.5% in August. Now, if we take out the contribution of food and energy from the calculation, we can see that the core CPI number in September is 3.3%, which is even higher than the 3.2% core CPI back in August. If we take the average of the headline CPI and core CPI numbers, we will get an average of 2.85%, which is very close to the terminal interest rate, or you can call it the neutral interest rate of 2.9% projected by the Federal Reserve. So in theory, 10-year Treasury bond should have a yield that is 1% higher than the neutral interest rate. So that means the anchor point of the 10-year yield would be around 3.9%, given the CPI inflation number we have in September. Right now, the 10-year Treasury yield is at 4.08%, which means that we are likely to see the yield continue to fall to reach around 3.9% in the coming month. As for 20-year Treasury yield, the anchor point would be higher at around 4.2%, and currently the yield is at 4.44%, which indicates that the 20-year yield also has much room to drop from its current number at are larger than 4.4% to around 4.2%. What it means to bond investors is that long bond ETF, including TLT, TMF, and IEF, still has room to grow in terms of its prices, although the room is not really large if we don't have a recession. If you have bought TLT or other long bonds like myself, we don't need to panic sell those assets at a loss, because TLT has a solid base price at around $93 per share in the market right now. Of course, if inflation comes back in the next 2 to 3 months, long bonds, including TLT and TMF, will tank in price. However, we don't think it would be so quick that inflation resurges again right after Fed's cutting interest rates. What's more likely is that the CPI number keeps steady for the next 3 to 4 months before we can see a clear trend on whether reflation is ignited or disinflation will happen because of economic recession. So in other words, we are likely to see TLT's price fluctuates in between $93 to $100 per share in the next few months, and TMF price will possibly reach $59 per share or higher in late 2024 or January 2025, based on the fact that CPI keeps hovering around 3%. Another good news to bond investors is that Israel government announced on October 15 that they did not plan to attack the nuclear facilities or the oil fields in Iran as a way to not over-escalate the conflict in the Middle East and appease its allies, including the US and NATO. The news itself led to a sudden drop of crude oil price of 5%, and energy stocks began to tank afterwards. However, the stabilization and decrease of oil price is very beneficial to help control inflation, and bond yield will likely move down because of the fact, and it will continue to maintain a bullish signal for bond prices for the next 1 to 2 months at least. Of course, we all know that the Biden administration had a series of actions in early October to significantly increase the number of new jobs creation in September, such that they would like the voters to feel that everything is booming, the labor market is strong before the election in November. We can also see a sudden increase in debt of over $500 billion over the past month in US Treasury's account with the Federal Reserve Bank, which explains why the number of new jobs surged in the recent month. This is because the government is doing deficit spending to hire government workers in the short term in order to make the numbers look good before election. Of course, this action skewed the labor market and is also inflationary. So right now, the Wall Street has pivoted from worrying about deflation and recession back in early September to focus on Goldilocks scenario, where the economy will have a soft landing or even no landing at all. That leads to the rally of the US stock market in the past few weeks, and as a hedge to the risks, bonds are abandoned by Wall Street investors in the short term, as capitals are moving away from bonds to buy stocks and push the stock market into new all-time highs recently. However, we should be a bit cautious right now because the US Department of Labor can revise down the job numbers in the future, as they did back in September of 2024 to revise down the total number of jobs created back in 2023. As a matter of fact, the economy is highly bifurcated, where the upper class and upper middle class enjoy the boom of stock markets, whereas the rest of us are still suffering heavily from the hyperinflation caused by the government and the Federal Reserve's policy. So in the future, we are talking about mid-November to January of 2025, when new data comes in and shows that unemployment is actually way higher than what the media tells us right now. The theme might be changed again from Goldilocks scenario to potential deflation or recession. If that happens, we might see stock price tank sharply and bond price rise again, just like what we saw back in early August of this year. Essentially, the Wall Street always changed their narratives after a few weeks, thus making retail investors guess and either chase the bull at a very expensive level or short squeeze and force us to sell stocks at a loss or rotate the capitals into areas that you would never expect. What we can do right now is to stay calm and patient when the headwind is not favoring our investment and wait for the right moment to take profit or invest again, rather than being influenced heavily by the ever-changing narratives from the media. Another market that catches the eyes of global investors is the stock market in China and Hong Kong. We know that since mid-September, Chinese government has come up with new stimulus packages and policy to stimulate its stock market and economy, and its action pushed global capital into its stock market, making the stock index surge over 30% in less than 2 weeks, which is kind of crazy. Many retail investors in China also participated in this bull run to try to make some quick money. However, the first big wave stopped suddenly after October 7th, as we can see from the Hong Kong Stock Index ETF (EWH's) price. It tanked from $20.3 per share in October 7th to around $18 per share right now, in less than 2 weeks with a drop of over 12%. That makes many investors worry and believe that the party is over for the China and Hong Kong stock markets, and bear is long staying there as the bear market in China has sustained for 2 years already. However, we believe that the party is not over yet, and there will be a second big wave coming into China's stock market between end of October and mid-November. This is because the central bank in China will likely have subsequent stimulus packages and policies coming in a few weeks to try to boost its economy and stock markets in order to mitigate the balance sheet recession problem it has endured for quite a while. It certainly will take a few weeks because the Chinese government will need to have high-end party meetings by the end of October or early November in order to determine the exact number and size of the new stimulus packages, but it will certainly be in the range of trillions of Chinese yuan. So we purchased 250 shares of Hong Kong Stock Index ETF, EWH, at $18.2 per share this week. We expect to sell them all by late November or December timeframe and secure a short-term profit of 15 to 20% from this trade alone. We will keep you updated on the progress of China's stimulus package and stock market trend. Now let's switch gear and talk about the stock market in the US. We know that the major stock indexes have either made new all-time highs or reached a level that's very close to all-time highs in mid-October. And surely that's deviating from the real economy, where the majority of us is feeling that everything is crumbling in terms of high costs of living due to hyperinflation and few job opportunities due to the high interest rate environment. The SP 500 index made a new all-time high of 5,871 points on October 14, and Nasdaq 100 index has surpassed 20,000 points a few days ago, and is now around 20,400 points, which is very close to the all-time high made back in July of this year. The semiconductor index also has a big increase over the past week. Most of the retail and institutional investors are now overbought in stocks, and people feel confident that the stock market rally will sustain for quite a while. However, we don't think it's a good time to buy stock market index right now because the price tag is just too high. As we enter November, we might see some turbulence around the presidential election, and entering 2025, there may be more volatility to stock market. It can be caused by the presidential election result, or regional conflicts in the Middle East, or something else that the Wall Street will create in the future. If that happens, that will be a great opportunity to buy the dip as the stock market index corrects by 5 to 10%. If not, we still need to be very patient and wait for cheaper times to buy in Q1 or Q2 of 2025. Almost all investors now agree that the bull market that sustained from December of 2022 till right now, which has already lasted for 2 years, has come to the late stage of it. We might see the bull market last a few more months into 2025, and there will be plenty of opportunities to buy the dip when the market tumbles, just like what we saw back in August and September of this year. Here is the CRI Investment Portfolio as of today, October 18th. We can see that the largest investment in our portfolio is still TMF, which is 3 times leveraged to 20-year bond, and it takes over 65% of our portfolio. The second place is for UST, which is 2 times leveraged to 10-year treasury bond. We believe that there is a high likelihood the yield will drop and bond price will increase in the short term. Energy stock Oxy comes in 3rd place of our portfolio, which takes about 7.5% of our position. Although oil price tanked after the Iran-Israel conflict soothes, we still believe the energy and petroleum stocks will have their upside in 2025, and we will continue to hold Oxy in our portfolio. Recently, we also bought 105 shares of Tesla stocks at a price of $220 per share on average. We know Tesla stock tanked after its earnings last week, and the market does not believe its robo-taxi story will create massive profits in the next 2 to 3 years. However, Tesla stock is relatively cheap right now, and news stories will come down the road to boost up its price to over $250 again. So we are still quite bullish on Tesla for now. The 5th place comes with UBT, which is 2 times leveraged to 20-year treasury bond, followed by SOXX, the semiconductor ETF, that takes 3.3% of our position. We believe the semiconductor index may have further growth to all-time highs in the next few weeks. Then is the Hong Kong Stock Index ETF, EWH, that we just talked about, as China's stimulus package will lead to Hong Kong stock market surge again in November of this year. We will keep rebalancing our portfolio as the market progresses into the year end, and we'll keep you posted if there's any significant change to our view in the stock and bond market. So that's the whole story of today's video. If you are a retail investor like myself and would like to know more about the US economy updates and our most recent trading activities, please give us a thumb up, share this video, and consider subscribing our channel, Charlie Retail Invest. We really appreciate your support. You're also more than welcome to leave your thoughts on the stock market and our economy in the comment section below. Thank you so much for your time, and I'll see you in the next video. Please take care.